Hi, everyone. Hope you're doing well. I have a very, very special guest with me here today, Andreas Antonopoulos, who is a Bitcoin advocate, author, educator, and speaker. And Andreas and I are going to talk today about Bitcoin and halving and many other things. Andreas, thank you for joining us today.
Oh, it's a real pleasure. Thank you, Tony.
Let's start with your background. Can you give us a quick overview of where you're from, what did you do before crypto, and when did you first discover Bitcoin?
Yeah, I grew up in Greece. I'm a geek. I discovered computers when I was just over 10 years old. My mother got me a computer. It blew my mind, changed the trajectory of my life. And I'm just fascinated and have always been fascinated by technology and how things work. I have academic training in computer science and networks and distributed systems, which is what I specialize my master's in. And after my education, I focus on information security as one of the main areas of interest for me, which involves a lot of cryptography and privacy issues. So in 2012, I came across Bitcoin. Actually, I came across it once before, I believe, um, in relation to some kind of gambling site. And I paid it no attention because I didn't know what it was and it didn't seem particularly interesting. But then the second time I read about it, I saw a link to the Bitcoin white paper. And for some reason, I clicked on it and started reading. And it completely changed my perspective and blew my mind because reading a technical white paper about it, I understood the relationship it had to distributed systems and kind of the novelty of the approach that was being used by Satoshi Nakamoto. And it captured my attention so hard that I dropped everything else. Within a few days, I basically stopped doing all of the other projects. I was a freelance consultant at the time. I somewhat gracefully fired all of my clients, dove into Bitcoin full time, reading, writing, coding, trying to understand as much as I could, and that's where it all started back in 2012. It was a very strange period of my life because of this incredible fascination and how deeply it captured my attention. And it's been a wonderful journey since. I now try to share my passion and enthusiasm about this technology from a technical perspective, but in terms that are hopefully easy to understand for people who are not technical, and explain why exactly this technology um, is something I'm passionate about.
Absolutely. And I've learned so much from you and your content. I've shared it with many folks who are new to Bitcoin and
Thank you.
crypto. You do such a great job of explaining it, and like you said, in more layman's terms versus too technical. Now, Bitcoin's third halving is soon approaching. Can you give us
Mhm.
a rundown of what the halving is about? Why this third halving is important?
Well, so you may have heard this idea that there will never be 21 million or more Bitcoin, that Bitcoin's supply is capped. And you might wonder, how is that actually achieved? How do you ensure that something does not continue to be produced infinitely the way national currencies are? And the way that's done is through a diminishing issuance. So Bitcoin is issued as a byproduct of mining, as the reward for miners securing the network and taking a risk while securing the network. And their reward comes in the form of new Bitcoin that is created in each block. A block of Bitcoin is produced every 10 minutes on average. And when Bitcoin first started, each new block contained 50 Bitcoin. And the way the issuance of Bitcoin is capped is that reward, it's called the block subsidy, that is in each block, is reduced by half approximately every 4 years. Bitcoin doesn't use years to do this calculation, it uses blocks. So every 210,000 blocks, the 210,000th block has half the reward that the previous block, if you like, the 2,209,999 block had. So that's what happened the first time. It went from 50 to 25 Bitcoin per block in 2012. 210,000 blocks later, at the 420,000 block, that reward went down to 12 and a half Bitcoin per block. And we're approaching, we're only 4 or 5 days out from the issuance of block 630,000, which will contain 6.25 Bitcoin in that block and thereafter. And then, follow that progression. Block 840,000, it will go down to 3 and an eighth, et cetera, et cetera. This process happens until the last block that's mined with a block subsidy in it. The block subsidy goes down all the way down to 1 Satoshi per block. A Satoshi is 100 millionth of a Bitcoin. It's the tiniest unit you can use, and it's the only unit that really exists inside Bitcoin. That will happen sometime in the year 2140 or so. And that mechanism is built in from the very beginning. So that's what the halving is. It's coming up soon. There's a lot of excitement happening around the halving, all kinds of speculation about what is going to happen, what isn't going to happen. And usually, and what I expect, is a largely uneventful event. Because the bottom line is that all of this is known well in advance, and everybody adjusts their expectation, including the miners, who have to decide if it's going to be profitable to continue to mine. And they make those decisions every day. There's nothing particularly special. It's a bit like when you turned 18 and 1 minute you're a child, the next minute you're an adult, but nothing happened in that particular minute that suddenly endowed you with the wisdom of adulthood. It was a gradual process that was happening both before and probably long after. We mark the occasion. And the one thing that certainly happens is the reward drops by half. But everything else is really just about how people react to this event.
So on the note of the mining, we're seeing a lot of institutional players are getting into the market and setting up shop. The world's largest Bitcoin mining farm being built in Texas. And we just heard Binance launching their mining pool. Iran yesterday issued a license to iMiner to start Bitcoin mining there. So what are your thoughts on these big players getting in and doubling down on Bitcoin mining, even if as the reward is getting cut in half?
Yeah, good luck to them. This is a very, very competitive, cutthroat environment. It's one of the world's true and very few real free markets. There's no barrier to competition. Anyone can start mining. All they need to do is build or buy the chips, the equipment to do it. And find the source of electricity. It doesn't matter where they are. You don't need a license. Although some countries do license their operators, that doesn't mean that operators didn't already exist who are operating unlicensed. Bitcoin doesn't care who you are, and mining is a completely anonymous activity that can occur anywhere in the world where cheap energy can be found. It's incredibly competitive, and in any free and open market where robust competition exists, basic microeconomics tells us that what will happen is that profit margins will converge to zero as supply and demand finds the most optimal way of doing this, which means that at any point in time, there are a few miners who are very profitable, a few miners who are just about break even, and quite a few miners who are making losses. And there's a lot of churn. It's very difficult to operate in this environment. And there's a lot of uncertainty. So good luck to them. It's not an easy market to enter.
Sure. And do you think they are, because we also see that they are building financial products like futures markets and ETFs and all of that. Do you think they're trying to grab control by mining it and also have the financial products? Like we see CME getting involved, New York Stock Exchange parent company. What are your thoughts on, is that good or bad for Bitcoin?
Well, I think for the most part, it's bad for those institutional players because what they're getting is not actually Bitcoin. A lot of these financial instruments, futures markets, et cetera, are not Bitcoin. What they are is speculative instruments that expose you to the price action around the value of Bitcoin as an exchange rate. But they don't give you any of the other capabilities or, if you like, features of being a first-class citizen of the Bitcoin economy. As someone who operates with Bitcoin in their business and runs Bitcoin nodes, etc., I authoritatively validate my transactions. I have the choice of which software I run, which determines the consensus rules by which I operate. If you own a stock in an ETF that perhaps holds some Bitcoin, you've ceded control of that Bitcoin. It's not actually yours because you don't own the keys. You've ceded control of the decisions around consensus rules. You've ceded control and access to that economy. So what you're getting is very similar to the difference between having a bar of gold in your possession and having a paper certificate that says that JP Morgan owes you some gold. Good luck collecting on that when it really matters. So there is also enormous risk because when they're operating in a futures market and shorting or margin trading Bitcoin and other cryptocurrencies, on the fiat side, there is unlimited fiat. You're using infinite amounts of fiat to buy finite amounts of Bitcoin, and these markets can be very punishing if your speculation diverges from market pricing. You cannot cover these bets, and the most likely time when these prices diverge is when there's a crisis, and that's the time when you really need the authoritative control over the scarce currency like Bitcoin. And when you're left with a paper certificate, you can really find yourself in a lot of trouble.
Absolutely. So let's talk about Bitcoin's use case. Right now, it seems to be positioned as digital gold, as a store of value. It has its currency values, of course, where I can send you a payment in Bitcoin, of course, but it seems to be moving more towards that digital gold. What is your thoughts around that?
I think there's two fundamentally different perspectives among the Bitcoin community as to what Bitcoin is and what it's for. And mine is quite different from that perspective. The reason a lot of people see it as digital gold is because their primary interest in Bitcoin is as a form of investment in capital protection. And mostly it's about speculating with a hope of riches. But to me, Bitcoin is a tool of political empowerment, freedom, and control over your own future. It's about self-determination. And it's about empowerment for individuals. And you don't get that by being exposed to the price through an investment vehicle. And you don't get that by simply buying or investing in Bitcoin, holding it in a vault somewhere, and then continuing to operate in the traditional fiat economy as if that's a sideshow. The most powerful experience you have with Bitcoin is when you start earning it through your productive labor, by selling your time or services or products that you make, and earning Bitcoin the way you would earn a national currency. At that point, you've achieved two things. One, you're a participant in a new economy that empowers you with control, direct control of your own finances. But more importantly, you've opted out of the smoke and mirrors game of the institutional players who have amassed enormous political power through their parasitic control over currency. So I think it's much more important to look at it that way. Is Bitcoin digital gold? Is it a medium of exchange? Is it a unit of account? Those things matter less to me than Bitcoin as a tool of political empowerment. And that's how I see Bitcoin. Bitcoin is for the unbanked and underbanked, the other 6 billion. It's not to further enrich speculators with disposable income who already have access to financial services and financial institutions.
Got it. So on the note of servicing or providing value to the other 6 billion, the daily use of being able to send and use Bitcoin for payments. There are critics out there who said, Bitcoin is 1.0 of crypto or blockchain. It's slow, the costs are very high to use, and we know there are scalability solutions being worked on, such as the Lightning Network. So I want to get your thoughts. Any updates you can give us about the Lightning Network, and what are maybe some other scalability solutions that can help improve the day-to-day where the network doesn't get clogged?
Yeah, I would caution people to be very skeptical. From the very beginning of Bitcoin, within a couple of years, everybody came up with their own idea, which was a better Bitcoin, a new Bitcoin, the Bitcoin 2.0. When people tell you that Bitcoin is the 1.0 of digital currencies or cryptocurrencies, that's usually because they're trying to sell you whatever they have as Bitcoin 2.0, and you should be very, very cautious. The fundamental reality is that the power and freedom of controlling your own money has a trade-off. And that trade-off is that in order to ensure there are no centralized parties that control the issuance and verification of transactions, everybody verifies everybody's transactions, and that has an impact on the scalability of the system. Now, that's very, very easy to fix. If you want a system that is highly efficient and highly scalable, you give control to a centralized institution. For the purpose of an example, let's call them Visa. And Visa will run a very, very efficient system where you are not in control of your money. And so efficiency isn't the goal here. And we should be very, very careful and skeptical of what trade-offs we're actually making in order to gain efficiency. Because if you lose freedom, then you're just replicating the existing financial system. We already have digital currencies that are super efficient if we're willing to sacrifice control. The Lightning Network gives us kind of a middle ground. It's a mechanism by which we can use the robustness, control, privacy, and self-determination of the Bitcoin blockchain, but engage in pure peer-to-peer transactions where we don't need everybody else on the blockchain to validate those transactions. We usually call that off-chain transactions. Because they don't need to be validated by the Bitcoin system. But because we each hold a valid signed Bitcoin transaction from our interaction, in any case, if something goes wrong, we can basically hand that transaction to the Bitcoin system to act as a judge and effectively adjudicate the difference. And that way we get all of the security of Bitcoin, but we don't need to go to the judge every time we want to make a transaction. We only do that when something goes wrong. And we can validate each other's transactions on a peer-to-peer basis. That's what Lightning does. Now, Lightning allows for basically unlimited scale of transactions. You can do millions of transactions per second, theoretically, because they're not verified by everyone, but you still have that security. However, it is a system that is complex and requires a lot of technology. And as any system that's early in its maturity cycle, it's very difficult to use. And it's difficult for those who are building the user interfaces, the wallets, as is the case in cryptocurrencies, to make the complexity disappear, to hide it behind an easy-to-use user interface. Now, this is the case with every technology. I remember the first web browser, the first email programs that I used, which were hellishly difficult and complicated. And in some cases, it took literally decades to get to a level where it was easy for everyone to use and intuitive. We're making pretty good progress. We now have kind of a second generation of Lightning wallets that have come out that successfully hide much of the complexity without losing any of the security and trust, and allow people to use Lightning in a very intuitive way that gives them the benefits of speed, low cost of transaction, and privacy without a lot of technical knowledge. But it's still early days. There's a lot to come. And I think it's one of the most exciting areas of cryptocurrency development right now.
Absolutely. I'm excited to see when the Lightning Network goes fully live and more global.
It is fully live right now. You can download an easy-to-use wallet, and you can conduct Lightning transactions and buy and sell things in a variety of places. I mean, I run a store where I sell things. We've been running the production Lightning Network since the beginning of 2018. So it's actually very much in operation today.
Got it. It's just more of scaling it, right?
No, it's
Oh,
already
okay.
scaled. It can handle lots of transactions. The issue right now is that the wallets are not as easy to use. Some of the second generation wallets are much easier, and there's lots of opportunities to get involved at this stage. Don't wait, jump in. The time is already here.
I'll definitely have to do that, and I'll certainly email you about maybe some of the wallet recommendations that you have, or if you know at the top of your head, and you can let us know.
Sure. I mean, one of the easiest ones to use right now is a wallet called Phoenix. Another one that's very easy to use is a wallet called Zap. But this space is churning
Yeah,
really, really fast.
sure,
And next week it might be a different set of wallets. I'm not endorsing any of these as
sure.
more secure or better made than others. I'm just giving a couple of examples. You have to take in mind that this is still experimental. It's still risky, and you can make mistakes that will cost you money. So it's a good thing if you limit your exposure. I wouldn't go and put thousands of dollars into a Lightning wallet, but because you can do very, very small transactions, you can experience a lot of the benefits by putting $10 in and then doing a lot of micro transactions, 5 or 10 cents, and then you really start seeing the power of this technology.
Very cool. There is a statement that was made recently by the founder of Bitcoin Suisse, which is a Swiss crypto broker, saying that potentially Bitcoin could move to proof of stake. Right now, it's on proof of work, of course, because Ethereum has proven that proof of stake is a viable algorithm. Do you think, from your perspective, do you feel that's something that could happen potentially in the future or not?
Not a chance, in my opinion, for a variety of reasons. First of all, Ethereum hasn't proven proof of stake. Ethereum still operates through a proof of work network. There is an experimental Ethereum 2.0 testnet that launched not even months ago, that implements partial proof of stake. But even that is still very experimental. It's not even adopted fully in Ethereum. Um, and we've seen a lot of proof of stake systems suffer from a variety of attacks that are not possible on Bitcoin. Proof of stake is not a replacement for proof of work. It is qualitatively different, and it involves some different trade-offs. Those trade-offs, in my opinion, are not desirable. Proof of work is, of course, expensive, and it is very heavyweight as a technology. But in return, what you get is an incredibly robust level of security that can resist even state level attacks against the protocol because of that. I think it may be true in the future that we discover that we can only afford one proof of work network. And fortunately, other proof of stake networks can actually leverage one single proof of work network to enable robust immutability. One of the things that's different between proof of work and proof of stake is that proof of work ensures that the past cannot be altered without a very substantial cost in energy. Even if all of the miners in Bitcoin 100%, not a 51% attack, a 100% attack occurred, and they wanted to change a transaction that happened 2 months ago, they would have to overwrite some, I don't know, 8,000 blocks. And in order to do that, they would have to expend an enormous amount of energy. They don't have the option to just not do it. They still have to produce proof of work. That is not the case with proof of stake systems. In proof of stake systems, if all of the stakers agree, they can rewrite the history at zero cost. Which means that when we say immutable, that has a qualitatively different meaning in a robust and heavyweight proof of work system like Bitcoin. And that is a very, very important capability or principle that I think is very valuable to the Bitcoin system. I would not want to see that. I would not want to see that changed. I think it's a very important thing to keep.
So, on the note of proof of stake, a question that came through from the community was, what are your thoughts on Ethereum and XRP being the second and third cryptos as far as market cap behind Bitcoin?
I mean, first of all, I don't think market cap is a useful measure of the value of cryptocurrency. Measuring cryptocurrencies in terms of market cap in the fiat exchange rates is like measuring the internet in terms of how many fax machines it's changed or replaced. We're measuring the new by the metrics of the old. And of course, there will be other cryptocurrencies that have a much higher market cap in fiat. Like, for example, if JP Morgan released a JP Morgan Chase coin tomorrow, they could put $100 billion into it and get the largest market cap of any cryptocurrency overnight. Would it be free? Would it be empowering to individuals? Would it be open, borderless, neutral, censorship resistant, immutable, publicly verifiable? No, 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 and no. And so what would it be? It would be business as usual masquerading as a cryptocurrency. So measuring things by market cap, I think, is entirely the wrong metric. Bitcoin would still be the system that gives you the greatest degree of freedom, even if it had less market cap, or if Facebook made something with more market cap.
Sure.
So the ability of banks to throw infinite amounts of fiat in order to inflate the valuation of the market cap of something that is measured in fiat is an absolute given. I think it's not only a mistake, it's a fascinating technique where the traditional system gets us to measure our value in terms of the one thing that they control, which is fiat, and use that as the metric. It's a bit like measuring car engines in horsepower. And guess what? Electric cars, we don't measure in horsepower. We measure them in kilowatt hours or kilowatts. And I think that's an important consideration. I wouldn't put Ethereum and XRP in the same bucket. They're fundamentally different in so many ways. And, while I do understand what Ethereum is differentiating on and what value the equation, I am yet to be persuaded that XRP is anything more than a mechanism to allow banks to maintain their central position and people to pretend to build something revolutionary while looking for the endorsement of the banks so they can gain relative power in that system. You don't change a parasitical system by asking the parasite to endorse you so you can be part of the parasitical system.
Great thoughts there. Now,
we're going to get a lot of hate mail for this episode. Brace for it.
So for CBDCs, and I got a couple more questions for you and we'll wrap it up, but what are your thoughts on that? Certainly, I see CBDCs as a result of Bitcoin's disruption. They're
central bank digital currencies.
Yeah. Mm-hmm.
Yes. Central bank digital currencies are once again an attempt to build a system that emulates the symbolism of open blockchains without actually implementing any of the capabilities of open blockchains. To use a term that's a bit controversial, it's a cargo cult attitude, where you build all of the external symbolism of something without understanding its essence at all. I often express these terms that tell you whether something really has the revolutionary characteristics of an open blockchain. I've created an acronym to help you remember it, and that acronym is RIPCORD, because when you have to bail out of the aircraft that is the current economy, you better have a parachute with you. So RIPCORD stands for revolutionary, immutable, public, collaborative, open, resistant, and decentralized. And you've got to ask, which of those things is a central bank digital currency? And the answer is really simple. None. It's none of those things. It cannot be any of those things because then it defeats the very purpose of a central bank digital currency. A central bank digital currency is a system of centralized control, vetting, authority, and surveillance that implements business as usual wrapping it in the bow of revolutionary terminology to fool you into thinking that something has changed.
Yeah.
You are not in charge in that system. You will never be part of that system. So from that perspective, it's irrelevant to cryptocurrencies. It's basically an attempt to steal just the marketing terms and pretend to be something you're not. I think those systems are incredibly dangerous, whether it's central bank digital currencies or it's corporate currencies that are doing the same game, but for private corporations like Facebook, the Libra coin. Those systems are incredibly dangerous. They're fundamentally totalitarian systems of control. They implement complete surveillance and control over your finances, and they get to decide who you can trade with, when you can trade off, and for what purposes. And if you don't like it, they can simply flip a bit in a centralized database and terminate your financial existence, basically turn you off. And at that point, if that system is widely used, you can't buy food. Now, that is an incredible political power. And if we allow that system to be the only system of finance and capitulate to the eradication of physical cash, we end up in a very, very dystopian, totalitarian environment. Why have elections if you can simply turn off the opposition party by turning off not only the finances of the opposition party, but also the finances of any individual that dares to associate with the ideas that they're promoting? That's the end of democracy right there. You never need to worry about using physical violence where you can use money as a system of control. And that is a very, very dangerous future. So CBDCs are irrelevant to cryptocurrency in as much as they don't have any of the features of open blockchains, but they are dangerous in themselves because they implement the exact opposite of free and open society.
Agreed. And along those lines, we're hearing that U.S. crypto regulations may be coming soon. We've heard from Steve Mnuchin. We saw Donald Trump tweet anti-Bitcoin sentiments. Obviously we don't know what's coming, but do you think it's going to be negative in a negative direction towards Bitcoin? And I know it probably cannot stop Bitcoin, but I want to get your thoughts on that.
Well, of course, it's going to be in a negative direction to crypto. The bottom line is that we're operating in a straight up kleptocracy. Kleptocracy is a Greek word which means rule by thieves. Look up who Steve Mnuchin is and what his past is. Steve Mnuchin is responsible for robo-signing millions of foreclosures and defrauding millions and millions of people from their homes during the 2008 crisis. Instead of that person being in prison, they're currently running treasury. That's what kleptocracy means. It means being ruled by thieves. And of course, they have the audacity to say that Bitcoin is used for criminal purposes. It is absolutely threatening. In fact, we should be flattered that mega criminals who are trying to exploit their parasitical position over control of money seem to be threatened by the possibility of a free and open system that allows anyone access to financial services without their particular authorization and approval. These are the same people that have now built a massive corrupt scheme to transfer trillions of dollars to their friends in power under the guise of the coronavirus stimulus package, which is another great theft. So, as far as what regulations they might try to impose, it's important to always remember the difference between justice and law. Just because something is lawful or unlawful doesn't mean it's just or unjust or moral or immoral. You can have immoral laws, and in fact, many of the most horrific immoral things that have happened in history were actually legal under the legal systems that they occurred at the time because immoral people were in charge of defining the law. If crypto is regulated in a way that attempts to disrupt crypto, that's not going to stop people from using it. What it will do is it will disrupt the on-ramps and off-ramps into and out of crypto, especially for institutional players,
Sure.
Which will essentially ensure that those institutional players cannot touch crypto. I think that's kind of cool. It's a bit like a poison pill. For those who really understand the purpose of open blockchains and cryptocurrencies as a tool for freedom and political empowerment, it will motivate them to spend more time inside the crypto economy and to implement it more as a circular economy instead of converting back and forth into fiat, which will become harder and harder.
Sure.
I think that's important. Now, there's a lot of people who are going to never touch crypto because they'll be afraid by these regulations, and those people will become trapped in the fiat system. When the ability to exercise economic freedom is made illegal, only criminals have economic freedom. So that's the bottom line. I think it's going to disrupt a lot of the institutional players, but it doesn't change the real value of this technology. All it does is it demonstrates that they're getting scared.
Right. Final question. Where do you see, and I know we kind of went down the regulations route here, but where do you see Bitcoin adoption in 2 to 3 years, even regardless of regulations or whatever it may be? Because nothing has stopped it so far. It keeps growing. There's more and more on-ramps being built, ATMs I'm seeing popping up everywhere. So I want to get your thoughts on that.
I think it's important to recognize that adoption of Bitcoin and other open blockchains happens where it's needed, when it's needed. And that's not going to be the United States, and it's not going to be most Western developed countries, because they either already have financial systems that mostly work and can entice people to use those systems, or regulate crypto in a negative way in order to discourage people from using that. But we've got to realize that more than 55% of humanity lives under dictatorship or totalitarian government, with shitty currencies that have terrible characteristics for saving for the future, with strict political controls that make money a totalitarian system of control. And they need Bitcoin. They need Bitcoin for the true reasons of being politically empowered and protecting themselves and the future of their children. So that's where you're going to see adoption, where it's actually needed. If a whole bunch of American investors decide they don't want to Lambo with Bitcoin, good riddance. They didn't really need Bitcoin in the first place. I'm actually more worried the fact that more Americans are going to end up needing Bitcoin, not because the dollar loses its value, but because they lose political power because of the way the system is structured, as we're already seeing. So I think in the next 2 or 3 years, we're going to see adoption of Bitcoin continue as it does now. And we're going to see it in places that are distressed right now. Iran, Venezuela, Argentina. We're going to see it in parts of Africa. We're going to see more of it in places where totalitarian control is imposed: China, Russia, North Korea, etc. And those are the places where this technology is needed the most.
Andreas, so much insightful information. Thank you so much. I've learned a lot today, and I will put a link to your website and Twitter profile. Everyone go check out Andreas' website. And thank you so much for taking the time to chat with us today.
It's my pleasure. Thank you so much for having me on the show, Tony.